Amish Shah is with us in the studio. Amish, first of all, welcome. Thank you so much for joining us here in the studio at NDTV Profit on our opening week. We're absolutely thrilled to have you here. Let me start with a sort of scene and context setting of where we are. And we just read the headlines, 70K on the Sensex, 21,000 and above on the Nifty. How are we going to sustain this? Are there enough factors to sustain? Because the next question when you see a consistent run-up like this is how long?
Absolutely. Tamanna, but before we begin, congratulations to the both of you and your team for this new beginnings. Best of luck.
Thank you.
And thanks for inviting me over. So look, in terms of the factors, clearly I think that the risks related to India are fading, whereas the outlook on the positives is improving. If you want to understand that even better, let's say just a few months back, if you rewind back, the concerns were around higher crude, higher geopolitical risks, higher yields in the US, maybe a hard landing in the US, and maybe a potential China stimulus. If you now think about it, most of these risks have either reversed or as of now, the impact of that seems very insignificant. But if you look at the positives in the meantime, earnings growth has held up pretty well. In fact, there has been some upgrades. Global macro, to Tamanna's point, now seems that in the next year is going to be supportive for emerging markets, and we'll discuss more. India macro has also continued to deliver quite well. In fact, recently, as we saw, the RBI governor increase the economic growth targets. That will feed into the corporate earnings looking much better going forward. It seems that the foreign flows will make a comeback, and domestic flows has already been robust. And if you take it forward with the political continuity that it seems to be, there might be a return of reforms, momentum, and that all of that put together, I would argue that valuations could expand further.
And less risk of maybe populist measures, which could have been suspected if the election outcome would have been, or I mean, nothing is certain in May. I'm just saying less risk of populism now.
Absolutely.
Considering what's happened. Okay. Amish, one of the factors that we've consistently spoken about over the years, and we'll get to the individual factors in your note. By the way, I must make a point here. Amish Shah in his note says that the base case for the Nifty is at 23,000 by the end of next year, which implies a 15% potential upside, despite conservative earnings estimates. But more importantly, the downside is only a 6%. So from these quote-unquote elevated levels, the risk-reward is still favorable. Is it the point that you made that the risk factors impacting markets have gone down, which is the case, or do you expect a bit of an earnings surprise as well? Because I remember the last conversation that we had, you had mentioned that the earnings momentum looks pretty strong.
So it's a combination of both the factors. So see, look, first of all, on some of the risks, I think market worries unnecessarily. Let me bring the point of crude. We have put an analysis in the note that says that if you put the impact of crude over a 10-year period, okay, so in the late 90s, whenever crude spiked more than 20%, markets would also come down by 20%. But if you look at between 2000 to 2010, there are 8 instances of crude going beyond 20%. Markets came down by 9% on an average. Between 2010 and 2020, markets were down by only 5%. Between 2020 to 2023, whenever the crude has spiked, markets have had zero impact. So 2950. Now, the reason, if you think about it, is because the impact or the weightage of energy stocks in Nifty, first of all, has come down over the years. Number one. Number two, over time, most companies that get impacted from crude have learned how to pass it on. And as a result, if you look at their earnings, whenever crude spikes more than 20%, the earnings impact on Nifty is almost close to 0%, which is why the impact on markets is also 0%. Right? So it is not such a big deal anymore. Obviously, India has become much larger as an economy. Crude is not such a big factor in the current account deficits anymore. Every $10 of crude increase impacts your current account by only $9 billion, which is not big in the scheme of the economy that we talk about now. So that's that. China stimulus, a lot of investors that we speak to, especially emerging market investors, worry. Again, there if you look at the trends, over the last 18 years, there have been 5 instances where China provided a stimulus. FIIs does see an outflow, but that outflow lasts only for 3 months. if you plot that data of FII flow for India and China on a full year basis, you will not notice any change because of the China stimulus. So what that basically tells you is that either the impact is insignificant or the impact is transitory. And as a result, we argue that on the back of these risks, if there is a correction, that's only a buying opportunity.
No. Just to flesh out the piece about global risks receding. Now that domestically the biggest downside, as per your note, is political stability, which seems very unlikely. Are we now willing to say that US recession is completely out of the picture? What about Europe next year? And in that sense, are those risks receding as well?
Risks are receding for sure, but the debate is going to be live, at least for the next 6 months, I would say. So whether US is going through a hard landing or a soft landing, up for debate. Whether dollar is going to weaken, one could argue. So a lot of these factors, in our view, will keep the first half volatile. But the volatility is unlikely to be unlikely to be what we saw in this calendar year. So this calendar year, Nifty swung by 20%. We don't think that the volatility this year will be that harsh, and as a result, we don't think that the corrections will be deeper. Specifically to your question, look, as of now, if you look at the US economic data, the consumption side of the economy is still holding quite well, and that is obviously supported by good wage growth, labor market data. If you look at it, it's all suggesting of income levels holding up, right? But the investment side of the economy, or the fiscal impulse of the government's fiscal deficit, that is receding. So it therefore looks like more like a slowdown rather than a crash, and that is what soft landing is what we talk about. And if that happens, then as of now, we do believe that come June next year, this will be a perfect setup for the Fed to pivot.
So in implications from an Indian perspective, you're saying the impact, whatever it may be, has reduced as far as India is concerned?
The short answer is yes, because now there are not too many unknowns. The monetary is tightening, we know about that. There has been support from the US fiscal is also something that we know. So incrementally, there is no sudden surprise that we can talk about, which is the risk from the market. So think of it like this, that not only the rates are heading lower, but the volatility in the rates in the US has also eased. So a calmer market, or a visibility, in other words, is essentially what the markets is going to look at as more, or the risk fading away, as I argue.
You guys at BofA must be very pleased, right? Globally, you guys gave the call to go long. The markets have done well. I remember your note saying that you expected 20,500 to 21,000, and that's played out too.
Yep.
And you are now constructive for going ahead. A point that I noted as amongst the reasons in your optimistic view is what you make, that you estimate $28 billion of domestic passive flows next year. Is this an anomaly? Put the data into perspective for us, because I know you dig data a lot. So is this $28 billion a really big deal relative to historical context?
It is. So let me put it this way, that if you look at the historic high FII outflows out of India for any particular year, that number is $16 billion. If you look at the historic high primary market activity in India, that number is $18 billion. So in the context of these two numbers, so when we argue as a worst case, one of the points that we make, that let's assume that our views on the global economy go wrong and we actually head into a hard landing. In that case, one could say that India could see historic high FII outflows. That historic high FII outflow is $16 billion. But if you have a $28 billion of inflows domestically, you are going to be more than offsetting that, and that limits your downside. It's not the only argument, but it is one of the important arguments.
And this is only passive. What could happen active is separate. Absolutely.
And I will put it across in another way, that if you look at the data of domestic inflows between, let's say, 2000 to 2014-15, on an average, India used to get $2 billion of flows a year. We are now getting $2 to $3 billion of flows a month. So clearly, from a long-term history perspective, the context has changed, and that is reflecting in all sorts of ways. So if you look at FII ownership of Indian equities, at the peak used to be 21.5%. It is now below 19%. Domestic mutual funds in the same time period, in just 3 years, has gone up from 8 to 10. So clearly, domestic flows are making an impact.
Interesting. So, Amish, what to do in a scenario like this? Because one is that you are constructive, the markets are looking optimistic, great. A lot of talk about how mid caps and small caps have rallied quite a bit. Could it be year of the large caps? Would you believe that, part one? And if so, within that context, where is it that you are advising your clients to park their new money?
So certainly, large over mid caps as an outperformance, we think will be the trade for next year. Given that we are bullish on India's economy, we also want to make a portfolio that is more growth focused as opposed to defensives. And given that growth in India is going to be much better than the rest of the world, we also want to be focused on domestic cyclicals as opposed to the global plays. To put it together in terms of sectors, we are currently constructive on financials, industrials, cement, which is all domestic cyclicals. The only defensive that we have in our strategy overweight skew is staples. We are selectively positive on autos and discretionary, and that's why it goes to our neutral weight basket. But on the global play side, where we are underweight, is IT, metals, healthcare, and all the defensives, as I said. So telcos, energy, utilities is basically our underweight basket.
Amish, I just want to get your sense on the consumption story, because while you're right, interest is coming back in the heavyweights, the consumer staples have seen a bit of a downtrend. There are concerns about rural consumption. So in your bigger picture, and when we were speaking about downside risks, is that one at all on the horizon? And do you think discretionary consumption is going to drive that space completely, and what would you like there? What kind of companies would you like there?
So am I concerned? The answer is yes. But is it factored in? I think the answer to that also is a yes. So if you look at our earnings growth forecast, for instance, we are suggesting that FY24 will be a 15% earnings growth, coming off to 11 in F25 and then 10 in F26. So we are already reflecting the concerns around slowing parts of the economy in our numbers, and so is consensus. Our numbers may be lower than the consensus, but consensus estimates is 17, 15, 13. So even they are projecting earnings growth momentum to slow down. But the good news is that a large part of this slowdown is coming from externally facing sectors like IT, energy, metals as an example that I mentioned, less so from consumption. The only sectors where we are worried and we have been conservative in our earnings is where a large part of the earnings growth is only reflected by margin expansion. Because in an environment where the global growth slows down, we think that it is unlikely that the companies will be able to retain the entire margin benefit. You will have to pass it on. So you have to choose between volume growth and margins. You can't get both, unfortunately, in a slowing global environment. And we think that the companies will go for volumes as opposed to margins.
Okay. Just one word on the kind of rediscovery of public sector enterprises, and whether it's banks, insurance companies, all across the spectrum actually. There is a sense that valuations are better than, were expected. Maybe they've been overlooked in the whole growth story, perhaps to do with the political stability part as well. But what is your view on them? Do you think inherent concerns about actual profitability or delivery on what is promised have receded?
So has the PSU pack got better? If that's your question, the answer is yes. Operationally, I mean. From putting valuations into the context, are we positive on everything which is a PSU? The answer is no. So utilities, for instance, I spoke about, we are underweight, but on the same, at the same time, PSU banks is something where we are overweight. So there has been an improvement, but more importantly, the trend I would argue in the PSU space is most of them are trying to move away from their conventional ESG negative businesses towards more ESG positive businesses, which is all new age. Versus coal mining, coal-based power plant, refining, crude refining, etc. You will see these companies talk about renewables, hydrogen, electrification, and so on and so forth. So that I think is going to be the new trend and the new growth driver for these companies. And they're all, to your question, they're all shaping up quite well in their journey towards being able to find the technology partners, get the management teams in place in order to make that transition.
It's interesting. We'll in fact have not a PSU, but we'll have a talk about renewables and power with Prashant Jain after this segment as well, viewers, so stay tuned. But last couple of questions, Amish. One is on the CapEx theme. You've been constructive there. You've cited past cycles as being a factor. Are valuations a concern, or do you think that the earnings growth will make up for it?
Valuations are a concern, especially again in the mid and small cap space. We have in fact
Not large caps, sorry, the MNC large caps, those also look expensive.
So maybe it differs in terms of what we call as large caps versus mid caps. But let me put it this way, that whatever is a part of Nifty is something that we are still excited about. But whatever is outside of Nifty is where we think valuations have run up quite significantly, and we've actually downgraded most of those stocks despite being positive on the cycle. So there are pockets where the cycle is for real, and I think we'll have a big momentum, and we are believers that it is a 10-year cycle. We are still in the third year of it. So it's going to be a long-term cycle, but we are not as excited on the back of valuations anymore on the entire spectrum of the space.
Okay. And lastly, Amish, a word on power, because that seems to be a story wherein the government is putting its might behind. The targets are stiff, but some of the power stocks, whether they are the power generating companies or they are the ancillaries which are supplying to these companies, all of them have had a really strong run in the recent past. Are you constructive here, and even if you are constructive on the businesses, are you skeptical of the valuations or not quite?
So again, I'm constructive on the cycle. I think the need to set up more capacities is for real, and therefore, the opportunity for business growth is for real. My worry now at these valuations is the potential of execution delays is not priced in. So it's as of now everything priced to perfection. So in case if the projects slip the timelines that are being guided for, then I do think valuations will lighten up.
All right. Thank you so much for that, Amish. Absolutely fantastic having you on the show today and in the studio, and especially to say that all things considered, you are saying downside only of 6%. So the worst case scenario also looks like a pretty good scenario, all things said.
Absolutely. The risk reward is in favor of India.
All right. Thanks so much.
Music to the ears, Tamanna.
Yeah, yeah.
Yeah, so well, that's the view from BofA Securities.